Good afternoon, everybody. We are Team 3, and we've done an economic analysis on Dollar General. Today we're going to discuss the micro, macro, 5-year projection and our recommendations for the future. Dollar General is America's largest discount retailer. It's been in operation for over 75 years, and it started out as a true dollar store, and today most merchandise is actually priced under $10. It focuses on offering everyday necessities in 4 main product categories: consumables, seasonal, home, and apparel. Consumables like packaged foods, cleaning products, and health and beauty account for the majority of Dollar General's sales. Dollar Generals are most often found in communities with populations under 20,000, and it's meant to be quick and convenient. Customers typically spend about 10 minutes in the store. These customers also tend to be middle to low income. They're more price sensitive and also frequent Dollar General's competition like Walmart, Costco, and other convenience stores. Tyler will actually jump in next with the microeconomic portion.
Thank you, Clark. Appreciate it. From a micro perspective, when we think about Dollar General, think about supply and demand. From a supply side, as I've said, that they really shoot for the everyday low price strategy. From a demand side, we're looking at consumers that generally are price sensitive and they have smaller pocketbooks. But the thing that we found is interesting when we look at the past 10 years and we look at the Great Recession, is 2 things that stood out is that Dollar General's inferior goods and their inelastic demand. When we talk about inferior goods, what we're saying is that the demand for your product actually increases when there are economic strains. In the Great Recession, this was a great example as well. So when we look at it for between 2008 and 2013, what we see that they actually increased their sales. For the year over year is almost 12%. And then what we end up finding out is as the Great Recession is starting to end, we start seeing that demand go down. So from 2013 to 2015, year over year dropped to about 8.5%. And from 2015 to 2017, we see it drop even more, right below 8%. So they are still growing over this time, but as the economic conditions got better, the demand for them got smaller. Again, we also talked about inelastic demand. What inelastic demand will tell you is that even though our customers are price sensitive, the small incremental changes to their prices doesn't actually change the demand for their product greatly. These are 2 parts, we believe, of it. One is that it's consumable goods, it's things that people need every day, it's not luxury items. But 2 is also because of that low price strategy. And how does Dollar General do this and actually be leaders in this? It's because they have a very robust and mature supply chain. They also don't depend their supply chain on 1 or 2 suppliers. Actually, if you looked at their top suppliers, their top 2 suppliers only account for 16% of their products in there. So that's what we have seen when we looked at the Great Recession in the past 10 years. Now, what is going to happen in the next 5 years? Well, what we know is that it's projected that economic times are continually going to get better. And with that, we expect that the demand is going to decrease as the customer's economic conditions get better. So what is Dollar General going to do as their demand gets lower because economic times is getting better? The only thing they really can do, we believe, is they're going to have laser focus on their supply and demand. They're going to have to make sure that they can maintain those margins that they have so they can still execute on their low price strategy. So next we'll get into the macro section, and for that we'll have Sarah.
As Tyler discussed in his microeconomic presentation, Dollar General posted tremendous sales results during the Great Recession. And while those sales have continued to be positive and grow, it is at a much slower rate. We see a similar trend when we look at operating margin and net income. Dollar General posted double-digit percentage growth in each of the years from 2008 to 2013 during the Great Recession. Following the Great Recession from 2013 to today, during in the economic recovery period, those measures, while they've remained positive, have slowed. Discount retailers are poised to succeed during periods of economic decline as consumers tried to buy their everyday products at the lowest possible price. These companies thrive during economic uncertainty as many consumers will change their shopping habits to choose price over every other customer preference. So now, if we want to look at some of the individual components impacting the macroeconomic or the macroeconomy, the first you have to talk about is unemployment. One of the primary factors influencing demand is unemployment. When more people are receiving a steady income, more people are able to make discretionary purchases. The unemployment levels really spiked in 2009 with about 10% of the workforce being unemployed to today where we are just above 4%. This means that consumers have more money available for discretionary purchases. The next component is the risk of minimum wage increase. During the last 10 years, there have been calls for minimum wage increases at really all levels of government. Dollar General employs 121,000 employees, the majority of which earn at the minimum wage. This would significantly increase labor costs and would constrain the everyday low price strategy of Dollar General. Finally, the decreased government spending. Due to Dollar General's low and fixed income customer base, they're really at risk of decreases in government spending. In the third quarter 2016, sales were negative for the first time in 36 quarters. And this was really due to food stamp benefits being reduced. This reduction in food stamps was a large factor in why Dollar General missed sales expectations for 3 out of 4 quarters in 2016. What happened was many of the states tightened the eligibility requirements on the SNAP program, which is the Supplemental Nutrition Assistance Program, and the result was that as many as 1 million Americans were eliminated from the program during 2016. So overall, there are many more factors in the economy that will impact consumer spending than Dollar General, beyond just the 3 that we've mentioned here. Increases in fuel or energy costs, increases in inflation or interest rates, increasing consumer debt, increasing healthcare costs, as well as decreases in customer subsidies, all of which will have a negative impact on Dollar General. This could lead to lower sales, decreases in inventory turnover, greater markdown in inventory, and ultimately a reduction in profitability. So now that we've looked at the historical impact of the microeconomic, let's talk about what we see for the next 5 years. As markets continue to recover from the Great Recession, consumer spending will increase, which could have a positive impact on Dollar General. However, the risk is that some of those current customers, as they have more wealth and increased consumer confidence and increased discretionary dollars, that they become less price sensitive and move those dollars to other retailers. Dollar General is also very sensitive to inflation. As the price of goods increase and things become more expensive, that will further constrain Dollar General's profit margin. They are very reliant on the Fed's strategy of a gradual interest rate increase to keep inflation in check. Finally, the current policymakers and politicians are campaigning on smaller governmental expenditures. This has already proven to be a damaging downstream impact to Dollar General. So if these government assistance programs are further scaled back, it is likely that this will continue to negatively impact Dollar General. So overall, while we anticipate that Dollar General's growth will continue, it is likely to be at a slower pace as both of the economic recovery and governmental assistance programs are scaled back. So with that, I'll turn it over to Cooper to talk about how we might mitigate some of these macroeconomic forces.
Thank you, Sarah. As it was so eloquently mentioned by our last 2 speakers, Dollar General has seen aggressive growth in the times of the recession. It has seen modest growth since then. We believe that we can go back to the times of aggressive growth if we can leverage two key areas of expansion. This would be to expand the product mix and to broaden the customer base. We believe that this can be done through one key change. This would be the addition of a small line of perishable items with one brand per item rather than a plethora of brands, which would totally change the makeup of the store as well as carrying costs, those type of things. We believe that this one change will allow Dollar General to get many more customers through the door. We also believe that it would potentially allow for higher margins on these perishable items that we would be introducing or existing products due to a greater overall experience. We believe that we could attract new customers who would become long-term relational customers due to our greater experience. This was as opposed to big box stores where we would have greater speed, convenience, and overall a more pleasant experience. Additionally, we believe that Dollar General should integrate a marketing strategy that would announce this change in their overall strategy and the addition of these perishable goods. Also highlighted in this new marketing strategy would be the differentiation of us from more big box stores because of convenience, location, parking, and just an overall smaller store so you know where things are. We also believe that we can offer more value than other neighborhood market type stores. We believe that this targeted rollout of strategically leveraged perishable items will allow for us to expand our product mix and broaden our customer base while staying true to the values that have made Dollar General the industry leader that it is today. So with that, thank you for your time. We hope this presentation has been informative and will be lucrative.